Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. With me, economist John Williams at shadowstats.com. John Williams, thank you for joining us today.
Greg, thank you for having me.
Well, first off, I wanted to bring up, you talked about, in the last time you were on, you said, well, I'd be surprised if the economy doesn't start falling apart in May. And shazam, we had Cyprus happen. Now, everybody is saying this is no big deal, and it's just a couple of tenths of a percent of the European economy. But, you know, they guaranteed small depositors, but then they put capital controls on. You got your money, but you can't have it. This is, people like Peter Schiff and other people are saying this is going to cause big problems around the globe. What's your take on what's going on in Cyprus in this whole bank deposit, taking people's deposit type scheme?
Well, that's a precedent that's contrary to what the Fed was hoping to put forth back in the 2008 crisis. At that point in time, when Lehman Brothers failed, I believe there were comments, internal comments at least from people in the Fed and the Treasury, this is not going to create a run on the banks. Well, anybody who thought that doesn't know the banking system and doesn't know foreign and domestic investors and the way money flees problems as quickly as it possibly can. It triggered a run on the banks. We had a crisis that actually threatened the collapse of our financial system as we know it. And in response, the Fed, the federal government, created, spent, guaranteed, loaned, whatever they had to do, whatever money was needed to prevent the system from collapsing. What Bernanke was afraid of was that you'd have a collapse of the banking system. And if you had a collapse of the banking system, you'd have a collapse in the money supply, and a big deflation, 1930s style depression. The only way that happens is if depositors lose their money. Back in the 1930s, when the banks failed, the bank went out of business. You had, irrespective of the amount of money you had there, you were out of pocket. Your deposit, you couldn't get it back. It was gone. The FDIC came into existence after that. And if you look at what happened in 2008, in order to stop the run on the banks, all the guarantees were expanded to cover the full system. All deposits were covered, so that you knew that you'd get your money back. If the depositors lose their money, the money supply collapses. That's money that's gone from the system. That's the only way you get the money supply to collapse, which gives you the big deflation. Now along comes the Cyprus circumstance, and what did they do? Where there were guarantees on the small deposits, those were honored. But anything over that, they effectively seized the funds to support the banking system.
But on the small depositors, they can't go get their 100,000 euros out of the bank. I mean, They got capital control, so you got your money, but you can't have it.
They've taken, I gather they've taken about 60%. We'd be lucky to ever see the remaining 40%, and indeed they can't get it out of the country. So what does that do if we have another crisis here? And we're not out of the woods yet. I mean, everything that was done back in 2008 to prevent a systemic collapse did nothing to resolve the issues other than it pushed the problems into the future. The economy is still in serious trouble. The banking system still is in serious trouble. The budget deficit is exploding out of control, and nobody in Washington, those who control the government, are putting together a package that can conceivably be passed by the existing political system. That means that you're going to see very heavy selling pressure against the dollar. You're going to see flight from the dollar. And in that process, you could very easily have another systemic crisis. And if you did, the question now is, prior to Cyprus, the example was what the Fed and the Treasury did back in 2008. They guaranteed all the deposits. They backed them up. So you don't have to worry about losing your money in a bank. It helped to quell the developing run on the banks. Now you have a circumstance where you have You have the precedent set in Cyprus that they can seize the funds, that they will not guarantee all the deposits, and if that's the case, you may have a much worse crisis now than you had back in 2008. Unless the government acts immediately if they start to see a run and they say we're guaranteeing all the deposits, you'll have a real problem.
Well, now it's $250 for your wife and $250 for you and $250 for your joint account. You can get about $750,000 if you title things right, maybe a little more, but it's no blanket. There's no blanket coverage for all the banks. But they have $10.8 trillion. I mean, I confirmed this with the FDIC. I walked through their line by line, PR thing with one of their, media people. That's right, $10.8 trillion in deposits and $33 billion in insurance. Now, they were quick to point out two things: no insured depositors ever lost money, and B, we have a $100 billion credit line to the Treasury, but that's only $133 billion max to cover $10.8 trillion. That's amazing, isn't it? Isn't that? I mean, couldn't something go terribly wrong? Couldn't we also have capital controls? Hey, you've got your $250 or $500 or $750,000, but you can't take it out of the bank.
If we had a run on the banking system, indeed, you could. You could have that type of circumstance. Again, they had that circumstance back in 2008. The response at that time was, we back everything, we guarantee everything. We'll back the FDIC 100%. They have whatever they need in order to cover. And now that's open to question.
Statistically, I mean, how does that make you feel? Or how do you read $10.8 trillion in deposits and $33 billion in the Deposit Insurance Fund?
Well, if the government didn't step in, they're going to have real problems. And it goes beyond that. You look at the Pension Benefits Guarantee Corporation; they're effectively bankrupt. They don't have enough to cover the pensions there, which are. That's a major problem. There are all sorts of issues throughout the government. The big problem, though, is the federal government. It's insolvent in the long term. It cannot possibly cover the obligations that it has in place. You have obligations now that, including net present value, are up close to $90 trillion, and it's getting worse by $5 to $6 trillion per year. And they're looking at balancing the $1 trillion cash deficit over a period of 10 years. Anything they do there is a positive, but unless they hit the big issues, the items that threaten national solvency, the sovereign solvency, you're going to have great difficulty ahead with the dollar. And again, when you see dollar selling, flight of funds from the dollar, that's going to be a strain on the banking system. It is a circumstance that if the selling gets very heavy, they could put capital controls on the dollar. So that's a likely type of thing. There'll be a lot of jawboning. There'll be intervention. But if you get back to 2008 style crisis, there's now a legitimate open question: how's that going to work out? Are they going to handle it like they did in 2008 and back everything? My betting is the U.S. will do that. Of course, that remains to be seen. But in that the Cyprus deal has been used, that's a precedent out there that raises that shadow of a doubt. And it's the confidence, it's the willingness of people to take risk that is key to this. You shake the confidence, the system becomes more unstable, and it's more vulnerable to shocks and surprises.
How do you view, with the Cyprus situation, the near term, where people are running into the dollar, the Treasury bonds, the 10 years down to 1.85% or so, stock prices are hitting all-time highs again. How are you reading this topping here in the market? I mean, if you watch mainstream media, they think everything's fixed.
Well, it is. It certainly is not fixed. And I'm talking in terms of being made better again. I mean, whether the stock market's rigged is another matter. Stocks at an all-time high. In nominal terms, that's true. If you take out the inflation, look at them in real terms, using the government's inflation, they haven't hit their all-time highs yet. They're still shy of that. In fact, net of inflation, the stock markets are below. I mean, the Dow Jones and the S&P 500 are both below where they were in January of 2000. In terms of the bonds, because of the low interest rates right now, there are two circumstances that are highly unusual, at least for a protracted period of time. One is that you have negative real interest rates. If you take the interest rate that they're paying you and subtract out the government's official inflation number, you get a negative return. You're not keeping ahead of inflation. The whole idea of interest rates is to stay ahead of inflation. And traditionally, the longer term Treasury bonds will trade maybe 3% above whatever the inflation rate is. So if you're taking official inflation at 2%, that would put the long-term bonds maybe up at 5%. You don't have that kind of a yield. The average person, instead of taking a negative return on a Treasury bill, which is safe, would actually do better going out and buying goods and services now that are going to be going up with inflation. Excuse me. They make more buying stuff that's going up with inflation than staying with Treasury bills. Now, we have an inflation problem ahead of us. There's no way that the long-term interest rates are going to stay as low as they are. That's artificial. That's created by the Feds buying the Treasuries. When interest rates rise, the longer-term Treasuries are priced based on interest rate. Interest rate goes up, the value of the bond goes down. So unless you're going to hold your note or bond for 10 years or 30 years until you cash it out, at which point conceivably you get the right amount of money that you'd agreed to when you purchased it, you'll see the value of the bond plummet as interest rates rise. So I'm not excited about either stocks or bonds right now. If you look at gold, where stocks are below where they were in 2000, adjusted for the government's official headline inflation, gold and silver are both up about 300% from where they were in 2000. And consistently in this last decade have outperformed the stocks. Wall Street loves stocks because they get commissions in selling stocks.
So a little more than a month ago, John Williams, you said that we might have the beginnings of hyperinflation. Now, we already had a big crack up in Cyprus. And so now, do you still think we'll start having the beginnings of hyperinflation in May? Do you think the economy holds together? Is there the actions of the government pushing this out? What's your read on how the the inflation and hyperinflation and how the economy holds together, throughout the rest of this year?
Well, my general outlook hasn't changed. I was talking about roots of it in May. That was along the lines of there being a very heavy sell-off against the U.S. dollar. I still think April, May is a very likely time frame for that, and it is a massive selling of the dollar that will set the stage for the hyperinflation. From that standpoint, the timing hasn't changed. What I would look at is, as a possible trigger here, will be the budget negotiations in Washington. You have the Republican camp that has put out or the House has put out a budget deal that will theoretically balance the cash-based deficit over 10 years, and it'll also make adjustments to Social Security and Medicare to make them more solvent. We'll see how that happens. There are things there I know it's possibly are not going to happen, cannot happen politically, such as the repeal of Obamacare with the president and the Democrats controlling the Senate. The Senate has a version that doesn't, for over the next 10 years, which does not balance the budget deficit even on a cash basis. The global markets are looking for the U.S. to address its long-range sovereign solvency issues. That's not going to happen. I mean, there's some talk about it, some nice things are being said, but as the negotiations get down to the wire, I see no chance of there being a happy resolution here. And in response, I think you're going to be off to the races with a dollar sell-off. We'll see how that goes. If that happens, that very well could be the proximal trigger for the early stages of hyperinflation.
And war on the Korean Peninsula, or a Iranian strike against Israel, or an Israeli strike against Iran, what happens in that scenario?
There are all sorts of things that can happen.
Does the market crash?
Certainly, I mean, I can't speculate as to how those different things would go. That standardly you'd get some kind of flight to safety, which would usually be the U.S. dollar. So that might help the dollar, but the U.S. is involved here. You'd certainly see some flight to gold. I think you'd see some flight to the Swiss franc. When we had crises brewing in North Africa, the Middle East, back in early 2001 or such, the flight to safety there, which normally would go to the dollar, went into gold and the Swiss franc. It'll be interesting to see how that develops, but it could have a positive impact temporarily on the dollar.
Okay. John Williams, economist at shadowstats.com. Thank you for joining us today on USAWatchdog.com.
You're very welcome. Thanks for having me.